If someone's
Good
asked,
morning, everyone.
morning.
Good afternoon, good evening, depending on where you are in the world. We're just going to allow another minute or two. That's better, Matthew Lamb. We had a great view of your ceiling there. That's
Yeah,
better.
I know. I was having problems with my table. It's now decided to rise to the appropriate level.
Super. That's good, mate. The up and down button on the side should help.
Yeah, I know. It stopped working.
I'm glad we're going to be entertaining, guys.
Fingers crossed.
I'm sure we will be. We'll just give it another 60 seconds or so. The number of people logging in is flying. So let's
You
just
can tell gold has hit a nerve, that's for sure.
yes. Yes, it has.
Interesting on that because I was talking to people before we logged on. Some people are logging on that are not convinced on gold. So, because I had a couple of messages, right? I said, okay, well, tell me afterwards if you are or not.
Yeah, I think it is interesting. Certainly holding something a bit different in a world of craziness might not be a bad idea, but we'll see
I
where the
think
conversation goes.
I think we released the marketing for this webinar on January the 29th. And then, of course, the day after. Oof.
Well, yeah, the market was answering some of your questions, maybe.
So yeah,
It's gone back up again though pretty quickly.
call that incredible foresight or pure luck.
Yeah.
We'll take whatever you want. I think we crack on. So good morning, good afternoon, good evening, everybody, depending on where you are in the world. A warm welcome. Welcome to deVere's first client webinar of 2026. For those of you that don't know me, my name is James Green. I'm the Regional Director for deVere in Europe and also the Investment Director for DVAM Consultancy. So if you hadn't heard of who DVAM are, essentially we have our own range of funds. So DVAM Consultancy is a product consultant, and in partnership with Matthew Lamb's company, Pacific Asset Management. Essentially, we have our own range of funds. We set them up, we do the legal, we do the compliance, we do the DD, we do the marketing, and then we go and choose whoever we think is the best particular fund manager based on that particular industry, sector, or asset class. For those of you that have money invested with deVere and DVAM funds, a big thank you from me. Thank you for allowing us. Thank you for trusting us to grow your money. I'm really excited for this webinar. If the last 15 minutes or anything to go by where we logged on slightly early, it's going to be a very good webinar. It's a hot topic. Is gold still golden? Gold has been a big talking point amongst advisors and clients and prospective clients. It's been a big talking point in various managers' WhatsApp groups. 2025 was a historic year for gold, 65% up, the biggest annual gain since 1979. It started the year at 2,600. It finished at 4,300 and in between had 53 all-time highs. Why was that? That's what we're going to discuss this morning. De-dollarization, geopolitical risks, tariffs, uncertainty, gold being seen as a safe haven that can't be printed, can't be hacked, can't be debased, and can't be defaulted on. And then in 2026, we've seen some extreme price swings. It hit 5,600. And then we had the worst trading day since 2013, right after we released the marketing for this webinar. That said, it's still 9% up over the last month and currently trading at 5,040. To debate this and knowing these chaps, probably lots of other subjects, I've tried to pick DVAM fund managers who may well have contrasting opinions. On my right of my screen, we have Chris Joy. Chris Joy is the CIO and portfolio manager of Coolabah Capital Investment, DVAM's manager for our Smarter Money Credit Fund, which was our fastest growing fund by AUM, assets under management in 2025. Below me to the left, I have Matthew Page. Looks very much like Prince Harry this morning. Matthew Page is the portfolio manager of Guinness Global Investors. He's our DVAM Global Equity Income Fund Manager. And Mr. Matthew Page, you've had a cracking start to the year, 5.6% up already. And as you may expect for a global equity fund manager, Matthew Page is positive on equities. Below me, we have Matt Roberts, Matt Roberts is head of Fulcrum Alternative Solutions. He runs the DVAM DLA fund. Had brilliant 12-month performance, over 10% up. When I last saw Matt Roberts in Milan, he was ever so slightly negative on equities. Maybe that's changed. Maybe it hasn't. We'll find out today. And then to my left-hand side, we have Nigel Green, who is deVere's CEO. A well-respected, regular commentator on global markets, was recently described by one major media outlet as a polarizing and outspoken figure. I think that's probably fair. To kick us off, though, I'm going to pass you over to Matthew Lamb. Matt is the CEO of Pacific Asset Management, and he's going to make sure that everybody behaves. So, Matthew Lamb, over to you.
Thank you very much, James, and welcome. Yeah, I've got the unenviable task of keeping this rabble under control. As James said, last year gold hit 53 new all-time highs. I can tell you gold today is about 3% of the share of total financial assets. Maybe that's something you should think about when building portfolios. The annual production of gold could fit in a single garage, average garage every year. That's what they dig out of the ground. And the Olympic gold medals are actually 92.5% silver. Sounds a bit of a con. Now we're going to move over to Nigel Green, who's going to kick off the subject. Nigel always has strong views. I think you're going to talk about 5-10 minutes, go through some points on gold, and then we'll probably go to Chris Joy, and we'll then go around the houses and see where we get to.
Fantastic. Thank you very much, guys. And very pleased to talk to everybody today. Chris is midnight, I think, so I think he's going to come next because he's just about going to sleep almost. But we'll keep you awake, Chris, with some good points on gold, hopefully. So I think everybody's fascinated by gold. Is it going to replace the dollar? What's really happening? And someone recently described it as a meme stock because it just literally was bouncing around, and social media was influencing gold. I mean, what on earth has happened? Okay, I think it's fair to say the world's changed, and there's some points that I want to make. And I believe personally, smart diversification, that when you're investing, the world has changed and you need a percentage in gold. So I'm going to be perhaps the most positive on gold, maybe out of all of us, and I'll tell you why. So if I go back to Nixon in 1971, it was the case that a dollar was fixed to gold. So in other words, they had to have gold to back the dollar. Okay, Nixon decided to change that. So all of a sudden, they didn't need to have the gold. They were able to print money. They printed $35 for every $1 that was around at that time. If you had a dollar, okay, that has lost its value by over 98% compared to gold during that period. Okay, in other words, the note says it itself. In God we trust. It really should say, in America we trust. Okay, they print it. Should you just depend on a currency? Well, you can argue if you're going to end up in that currency, maybe you don't mind. Okay, but the reality is that if you're in an international world, as I am and many of you are, I think it's smart to have some diversification. The system is broken. Gold fixes that. If you go back to 2022, Russia, Ukraine, since then, there's been 3 times the demand for gold. So imagine you've got a country, all its assets frozen. Guess what? Okay, people are looking for something else. Countries are looking for something else. You look at it and you'll see 3 times the demand, and even at record highs, 22 central banks around the world last year were buying gold. Morgan Stanley said that it used to be 60-40. So Matt mentioned this earlier, Matt Roberts, where it's a change in the system. It used to be that if you were in equities, you'd have 60%, you wanted a portfolio, and you'd have 40% in bonds, because what happened was when bonds went up, when yields went up, okay, then equities go down. Okay, that's no longer the case. So the 60-40, it doesn't work anymore. That's the reality. So if you have 60% of your money in equities, if you're bullish on the market, a percentage in bonds, then you'd have a percentage in gold. Okay, now we would perhaps argue from a company perspective, I'd probably have a slightly lower percentage of money in gold. So even though I'm arguing it, I would say it's somewhere between 5 to 15% of a portfolio, because it's a hedge. Okay, I like bonds. I like what Chris does because he's actually able to beat the bond market, reduce the volatility. Okay, we talk about Matt, and Matt Page is going to be talking about equities, and Matt Roberts in a similar way, making sure you're in the right places, the right sectors. Okay, just having an ETF 60/40, forget it. Okay, that for me is finished. China, India, it's half the world's population. Okay, they'll tell you that there are people queued in jewelry shops buying gold or silver. Spoke to Mark Everett in Hong Kong this morning. You can see there's actual demand for it. So it's not just central banks buying it, people losing some faith in the system. America, $38 trillion of debt. So there's some, do we really want to trust America? Do we want to trust this debt? There's some of that, but people actually have a demand as well. And that's two of the biggest, or the two biggest countries in the world that are buying it. You've got a new Fed chairman coming in, Walsh, and of course that's controversial as what he's actually going to do. But I think it's pretty sure that he's going to reduce interest rates. Okay, if you go with lower interest rates, particularly if you go aggressive, perhaps even to inflate the debt away, that's possible. It was done previously. You think that's possible, then that's good for equities. That's good for Chris, who's managing a bond fund in particular. It's actually good. The only place it's not good for is leaving your money in a bank account. Because if you've got your assets in a bank account and inflation's coming through, okay, that of course isn't going to be able to give you value. Right now, you're in a situation whereby, for me, the new Fed chairman, he's going to try aggressively. I mean, after all, Trump's been talking about it so long, it would be naive to think they weren't going to try and reduce it. Of course, that could cause inflation. And then what happens next? Okay, well, being in the right assets would make all the difference. Social unrest, I've only got it down as a percentage. So many people look at the world and you can almost call gold, if you think Trump's crazy, buy gold, because every time he does something crazy, then guess what? Gold goes up. So you could take it that way, but you can also look at the world and say there is potential social unrest in the future. I've only got it down as a 5% in my personal opinion, but I think there's a chance, right? You talk about America, you talk about the rest of the world. Last year, there were 142 major political protests in the world in 68 different countries. So it's not just America, where there's people not happy. You've got more wealth divide than ever before. There's 12 billionaires that have more money than 50% of the world. So you're in a world where potentially you've got social unrest. Okay, if there's social unrest, okay, guess what? Gold as a percentage for me, again, just makes sense. Okay, I'll go with currency really as my last point before I hand over to Chris. On the last webinar, we talked about, and maybe it was the last one before that, which currency is best. And I said at the time, I think that's the least bad. Okay, which almost famous last words, because the reality is that which currency would you choose? Okay, well, Chris may would go with the dollar's going to be okay in the end, but the investors are saying we don't know. In other words, where would you buy? Would you buy sterling? No chance. Would you buy euros? Oh, that could all go wrong. Would you buy Japanese yen, aging population? Oh, hang on a second. Which one? Swiss franc, 11-year high. So which currency is best? Okay, well, because people don't know which currency is best, because it's almost an impossible task, there is a percentage, as you can see, and that again is driving gold. So I like it as a percentage. I think it's a sensible hedge. Do I think that some of these fund guys will actually beat it? Okay, I actually think so, but I think that nevertheless, having a sensible percentage, either in something that we've structured as a company, we have some structured notes which will give you 150% of gold, silver, which is nice. Or I also like gold miners. Okay, why? They're actually extremely profitable and it isn't priced in to their stock price right now. So even if it goes down, okay, some of those stock can actually gain. An advisor can sit down and explain that to you in detail and talk about that particular opportunity. So for gold, for me, a percentage of your portfolio.
Thanks, Nigel. Very comprehensive and extremely helpful. Actually, there was one question talking about why don't we have gold in some of the deVere portfolios? And actually, the answer is they do. Through our multi-asset portfolios, through some of our diversifying liquid alternatives that Matt Roberts and team run, there are significant exposure to both gold producers and physical gold. So whilst you might not see it on the outside of the tin, it's definitely in the ingredients of your portfolios. Let's move over to Nigel created some fantastic points there. And I think one of those points was talking about de-dollarization, talking about this concept of the reserve currency of the world perhaps not being the reserve currency of the world anymore. And where does that go to if people don't want to own dollars? Maybe they want to own golds. He mentioned central banks all over the world buying gold. Now, Chris, I know you're a bit of a fan, or maybe a fan, of what's going on in the US, and maybe the unexpected craziness that we sometimes hear about the US could lead to much growth, stronger growth than people think about. Do you want to talk about that growth, the impact that might have on the bond markets and inflation, and maybe any views on gold?
Yeah, delighted to do so, Matt, and thank you to the deVere team and everyone who's dialed in today. Really appreciate the opportunity to engage with you guys. Let me just quickly respond to Nigel. Masterful performance, Nigel. Agree with pretty much everything you said. I thought it was very, very compelling. In respect of gold, I definitely concur that it has a role to play in portfolios as a hedge. I think it's a much better hedge than cryptocurrencies, which I think are primarily pure Ponzi. There's no doubt that it's unambiguous. There's been a strong de-dollarization dynamic over the last 12 or so months, primarily in response to the perturbations and ructions caused by Trump. A little anecdote. We got an email to our public info at coolabahcapital.com email address from Saudi Aramco, one of the biggest oil companies in the world, wanting to meet us in Australia. And when we met with them in person, they said, we're just super keen to diversify out of US dollars. We want to buy Aussie fixed income. I thought that was a pretty telling little anecdote. And I think Nigel's right that when Russia invaded the Ukraine, their dollars were frozen, and the role of the US dollar as a form of insurance of last resort for dictators and despots was eviscerated on the spot. And so any non-democratic state has had an urgent imperative to diversify out of US dollars because they can no longer rely on the dollar as a source of liquidity in a crisis, given what happened to the Russians. I do think that this is, however, a transitory process. It'll be like a pig through a python in the sense that eventually people will diversify out of dollars and the pressure on the dollar will dissipate. I'm also very interested in the idea that you intimated to, Maddie, about re-dollarization. I think what we're seeing in the US right now is the strongest productivity growth in the world. We're seeing stimulatory fiscal policy, stimulatory monetary policy. We've got a profound change, obviously, in the political zeitgeist, a huge surge in entrepreneurship and innovation, propagated by the AI revolution. We've got a massive capex boom that's unfurling. The capex intentions of the hyperscalers are being systematically understated. And so every year they're massively upgrading these capex plans, which will be very positive for the US economy. So we've been bullish on the US economy for the last 12 months, arguing that it'll be much more resilient than people think. I think, as Nigel mentioned, we have an ostensibly dovish Fed chair replacement, Walsh. But his history has been as a preternatural hawk. And we're looking for a hawkish pivot from the Fed this year as a function of the strength of the US economy and the fact that there's really no new labor supply. The Republic has the lowest population growth since its inception. The borders have been closed. Border crossings have dropped precipitously. Trump has been incredibly effective at cauterizing illegal immigration, and that could ultimately precipitate wage price pressures in the sort of medium term. And obviously, we have the midterm elections later in the year. So I think that ultimately that could lead to something of a re-rating of interest rate expectations. We've already seen that a little bit. We're also seeing a resurgence in inflation in various economies around the world. We're seeing sticky services inflation. For example, in Australia and New Zealand, we've seen a significant bounce in inflation. The Aussie Central Bank, the Reserve Bank of Australia, is the first developed central bank in the world to hike interest rates this year, embarrassingly, utter humiliation, following the easing cycle post-pandemic. And we've got a real problem with inflation in the Antipodes that I think there's a reasonable prospect of seeing similar patterns play out globally. One contention I would make, and I am obviously subjective on this subject, but empirically, it's very, very hard to find any cheap asset classes today. In terms of the raw data, nothing looks cheap except for interest rates. The overnight policy rate set by central banks all around the world, whether it's the US, UK, Australia, New Zealand, Canada, is much higher today than it has been on average since the 2008 crisis, or indeed over the last 25 years since, say, 2000. But interestingly, this is also true of 10-year government bond yields. They are much higher today than they have been on average since 2008 or since 2000 for good reasons, because we have relentlessly profligate politicians running large budget deficits, issuing a lot of debt. We have very credible concerns about inflation. I think that genie is not in the bottle, notwithstanding some of the partially positive data out of the US. Trump was a genius shutting down the government last year and sandbagging all the data. And it's very difficult to kind of discern precisely what's going on in the US still to this day as a result of that interruption. But interest rates are cheap. They're higher than they have been.
Chris, can I ask a quick question on the thing about interest rates? Obviously, interest rates have remained elevated. Yields are higher. 10-year yields are higher in Japan, in the US, etc. And but you're also saying, and some of that is maybe because the bond market's telling the truth. There's more inflation in the system than people think. But if we get this capex boom and AI isn't deflationary, then doesn't that mean, with very tight labor markets and sticky services, wages and stuff like that, doesn't that mean interest rates continue to go up? And therefore, actually, that makes them not cheap.
Yeah, 100%. And this is a key point. So one of our big ideas over the last 6 to 12 months is that AI will not be the deflationary sort of transformation that almost everyone believes without exception. We've argued the exact antithesis of that point. So we contend that AI is inflationary. Everyone says it's going to eviscerate the management consulting industry, but the management consulting industry has reinvented itself as AI implementation experts and is growing quite rapidly. Likewise, radiographers. Everyone said that radiographers would be dead as a doorknob as a result of AI, but actually radiography demand has outpaced broader labor market demand. So the AI hyperscalers are all competing for the same resources. The resources and inputs that you build data centers with, energy, chips, memory cards, and we're seeing inflation in a lot of those inputs. So I think in the short to medium term, if we get net wealth effects from AI and we don't get massive decimation of labor markets, you could see significant inflation and higher interest rates. So you're 100% right, Matty. And this comes back to Nigel's profound point about the 60-40 portfolio. The 60-40 portfolio, the 40% in bonds, was predicated on fixed rate bonds. The deVere Smarter Money Fund is not fixed rate, it is floating rate. The deVere Smarter Money Fund benefits from higher interest rates. If central banks hike, like the RBA has been the first central bank to do, declaring that it has failed to deliver price stability, it's failed to normalize inflation back to target. If this becomes a global phenomenon, then your safest asset class will be cash and floating rate bonds. So, again, I'm kind of plugging our story here, but the deVere Smarter Money Fund over the last 12 months has returned 6% net of fees, well above the cash rate. And if interest rates rise, and another key point we made last year was that we thought that the biggest problem in markets was nobody was pricing in the prospect or any probability of rate hikes. There were no rate hikes priced into the US curve over 26, 27, 28, zero, right? At various points for most of last year. And that's now shifted somewhat. But if we do get interest rate increases, if we do get a rebound in inflation, this will be profoundly problematic for many, many asset classes, property, equities included. Gold will probably be a beneficiary to, again, Nigel's point about the diversification and benefits of such.
So just to wrap you up before we move on to, you mentioned something a little bit controversial in there, other than Trump was genius by shutting down the government. But you talked a little bit about cryptos. One of the things I've been surprised about in this sell-off of crypto, which obviously has been quite significant, is that it was supposed to act like a digital version of gold. And you've seen the correlation between gold and crypto.
That's absolute horseshit. Like the bottom line is, Bitcoin is not an inflation hedge. It is not a stable store of wealth. It is not a medium of exchange. It is not cryptographically secure. Everyone's freaking out now about quantum computing, and we saw Bitcoin plummet to $60,000. Bitcoin in the last week has been trading lower than its late 2021 levels. So I think it's an absolute fraud. I think gold, on the other hand, there's as Nigel articulated much more eloquently than we can, a super compelling case, and it's empirically proven over centuries that it does have a diversification value in portfolios. Cryptocurrencies, on the other hand, I think that remains an outstanding.
It's a newer thing. I mean, that's what makes a market. People have different views. We're going to move on. Thanks, Chris. Delivered at 100 miles an hour as always, but very clear. Mr. Roberts, let's maybe go over to you. I mean, you get you're fortunate enough not only to invest across asset classes, but you also meet hundreds of fund managers as part of your job and hear the views of some of the brightest brains in the industry. Distilling some of that along with your views, let's touch on gold, but also maybe some of the points that Chris talked about around asset classes being expensive.
Sure. Yes, we've had some gold in DVAM DLA for quite a long time now, and actually it was fascinating last year because we had to trim the position like 3 times because it just kept going up and up and up, and he was like, we have to rebalance this and risk manage it and everything. So why has it been going up? There's probably three main reasons. First of all, trust. I think trust is the key word when it comes to geopolitics. People have been worried about Trump and what he might do to political systems, and so they've been looking for safe havens. If you look across the world and you try and find a good safe haven, it's difficult, right? I mean, you look at the yen. There's a lot of debt to GDP in Japan. It's been coming down a bit, but the interest rates have been going up, and people have been worried about the economy to a degree. It's a bit more politically stable. Maybe that's going to change, but it's certainly not worked as well as gold, right? And you look at the Swiss franc. You don't get any yield in Switzerland. You put your money on deposit there, you get 0% or something like that. You look at 10-year treasuries. Well, that's the whole point, right? That's the point, that people are worried about the trust in the US dollar and treasuries. And so gold ended up being the answer. Second reason, probably central banks have been pumping. I mean, central banks have really been pumping this. I mean, you look at the rates at which they've been buying gold, it's been unbelievable. Some of these central banks looking for this stuff.
So, Matt, do you think the marginal buyer of gold is the central banks? I mean, we talk about people queuing up. I mean, I heard a great anecdote the other day that in the US, people are chopping in their gold IWC watches because the gold in the watch is worth more than the watch, which is a kind of weird thing. What do you like?
Chinese central bank, Russian.
It's Chinese central banks,
absolutely.
Russian central banks,
yeah,
European central banks, everyone de-dollarizing.
I think so. And that's also led to, let's say, like a technical flurry as well. And so you've had a lot more technical players in gold over the last 6 months, which is why you got some of this volatility so far this year as well. Actually,
that's the momentum. That's the momentum junkies that are seeing that it go. And
I mean, I would say, just on the back of that, I would say if you want to do some gold, I'd say you've got to have 2 approaches at either end of the spectrum. You are going to be a long-term holder and just make sure you keep rebalanced and have your percentage there, or you want to be an uber trader, and anywhere in between is quite dangerous, I would say, because you can get whipsawed pretty bad. So that would be, and maybe there's a third reason as well where I think it's gone up, and actually this is maybe underappreciated a little bit. Industrial use, like people, gold goes into phones and things like that. That's more of a thing for silver, right? And so we've seen the vol in silver, and we see how much silver went up last year. 20 grams of silver goes into every solar panel, right? Just as an example. And people have been thinking, well, all these solar panels, are they selling so many of those? Well, maybe not in the US so much. We've seen what happened with Trump there, but China solar panel demand has gone through the roof. It is absolutely insane. And so the precious metals overall have been really interesting. Chris talked about so I would have some precious metal. We've got some gold. We're keeping it. We just risk manage it and making sure we trim when as and when needed. Chris mentioned about looking for cheap asset classes, and I think that's a fascinating conversation right now. I kind of agreed with the things he said, and I back him up on the radiography point as well, because we've got an investment with a radiography company who have seen demand go through the roof, and they've been having to hire people, even though they're using AI tools and things like that. So it's really interesting. But I would say there is still some cheapness in the small mid-cap area if you look at Europe and the UK. And I'm actually surprised there hasn't been more repatriation of assets back from the US. With still got 70% in US equities in the global equity index. You're still very concentrated in the the big tech firms. Not all of these tech firms are going to succeed as a consequence of this big AI movement, right? There's going to be some that fail, and I'm surprised that the institutions haven't moved the money back a bit quicker to some of the European and UK markets. And I think we're starting to see signs of them doing that. I've been having conversations with people where people are starting to change their regional weights in portfolios and things like that.
Yes.
That's been quite interesting. And we're big
American
advocates of that.
exceptionism is, I guess, in question. I think that people often don't realize is outside of the US, we've sort of been big beneficiaries of holding US equities and a stronger dollar. So you've ended up this double whammy when you translate it back into euros or sterling. What's interesting is the US, of course, has never been bothered to buy Europe, because if it bought European equities, it didn't do very well. And when they translated it back to dollars, because the euro that was weak, you lost further assets.
Yeah.
And I think that that's starting to change. You're seeing dollar portfolios that are invested in European and emerging market assets, converting them back into dollars. They're getting the performance of a cheap stock market and the strength of the foreign currency. And that could see marginal flows move out of the US and into more diversified regions, which could see some of these cheaper asset classes move.
Yeah, I mean, it's been interesting. The home bias there's bigger home bias in the US than there is in the UK, and the UK's only got like 2-3% of the index or something. So that's a remarkable thing. And so it's not just necessarily repatriate the UK people repatriating back to the UK. It's like potentially US investors moving some from the US over to the UK and Europe as well. That I think is interesting. So we have, if the global equity index is 70 odd percent or something like that, high 60s in the US, DVAM DLA, we're about 35-40. I mean, serious difference. You got the geographical diversification, and I do think, to Nigel's point, diversification is incredibly important at the moment, and more as important as it's ever been. The right kind of diversification. There are some assets that are not going to work over the next 5-10 years, and I think in the DVAM model portfolios, you've got a really interesting set of assets that's going to help navigate this really nicely. And I think so. That's I think a really important point as we try and get through the next few years.
Thanks, Matt. Enlightening as always. We've got too many Matts on this call, but we're going to go to the next, Mr. Page. We've talked a lot about equities. You're in the sort of companies that I guess can have stable balance sheets, that can grow their dividends, that may be a little bit more protective in an environment where the volatility of growth could be extremely volatile. So tell us about, are you in the gold miners? Are you overweight US? Talk a little bit about where you're thinking and whether all this noise, de-dollarization, inflationary pressures, whether they impact any of the views that you have in terms of positioning.
Yeah, well, thanks very much for having me today. And it's been a fascinating conversation so far, which I've really been enjoying. But to answer your question, when it comes to sort of gold as an asset class, it's almost the antithesis of what we invest in, because we're investing in equities that pay dividends. So the lack of income, obviously, that comes from a commodity like that is completely against what we're looking for. But obviously, we could own gold miners. Historically, we have not owned any gold miners because the return on capital of the companies that extract gold out of the ground has been very low for a very long time. Now, the change in the gold price that we have seen clearly changes that dynamic. And so, Nigel was saying earlier how he thinks that's an interesting place to be, and I would agree. If we believe this gold price is going to remain high for a prolonged period of time, the history of commodities demonstrates that commodities are cyclical in nature, right? We have periods of strong price growth, and then they come out of favor again, and we start again. So for the purposes of CEOs in mining companies trying to determine when is the appropriate time to allocate capital to generate an economic profit for the companies that they run, it's a very difficult decision. And I think, typically we will see them invest and expand capacity, later in the cycle if this persists. What I'm looking for in my portfolio that I run for deVere is for companies that consistently generate high levels of profitability for a decade, every single year for the last 10 years. That means they're going to be generating profits through recessions, through difficult periods. That means they're going to pay me a dividend every year that I can rely on. And because they are growing their businesses, that means that dividend stream is going to grow over time. And that's exactly what we have seen over the last year as well.
And why do you think this year the market is I mean, the market goes in and out of favor of whether they want dividends or whether they want growth. It seems that this year, certainly the last 6 months, that people have come around to your way of thinking. Is that because people are worried about fixed income instruments and so they're looking for their yield elsewhere, and maybe equity income is the way to generate the yield? Or is it a more of a worry about growth and AI exuberance, and therefore let's move to safer quality assets?
Yeah, I think it's probably a bit more of the latter. I mean, I think the backdrop for equities looks pretty positive, right? As sort of Chris was alluding to earlier, you've got, big fiscal stimulus coming through in the US and Europe, right? In the US, in the form of the one big beautiful bill. In Europe, it's big defense spending increases, right? So, money going into the economy from governments. Secondly, you've got this sort of monetary stimulus, interest rates being cut in the US, very likely to happen again this year. That's another sort of positive for the economy. You've got this deregulation that's going on in the US as well. And then you've got this huge amount of capex being spent by companies, particularly through the AI hyperscalers, right? And they're all upgrading how much they are spending this year. The earnings results that we've seen enormous numbers upgrades coming through, to the point where they're going to spend this year, 5 companies will spend over $600 billion. And that's probably only just going to go up. And to put that in context,
Is that like a percent of or two of US GDP?
To put it in context, it's the entire GDP of Switzerland, right? Coming from 5 companies. So this is an enormous amount of money. And so in that backdrop, you look at, what does that mean? Well, that means probably stronger earnings growth for companies. But what we've seen this year is that these big hyperscalers have been increasing their capex, because they are seeing a profitable growth opportunity there. The message from them is very, very clear. They're sold out of their capacity. They can't build it quickly enough. They've got customers waiting to take advantage of it, and it's profitable. But I think the other element of what you're seeing is that many of these AI model builders, like OpenAI and what have you, who are committed to spend with these hyperscalers something of the order of $1.5 trillion, and OpenAI generates revenues of about 15 billion, right? So this is sort of many orders of magnitude greater than they're currently creating in revenue. And if investors are going to continue to fund these private companies, or they're going to list their shares on stock exchanges, then they've got to demonstrate real world opportunities where they're going to disrupt industries, create big economic profits, right? This is not just you or me or anyone else subscribing to ChatGPT. This needs to be massive impacts on industries. And so we're seeing companies really try and demonstrate, as we've seen over the last few weeks in the kind of.
So if I can I pick up on that as well, if I
Sure.
may join in, because it's a very good point. I mean, you see there's 600 billion that's being spent. You got 200 billion from Amazon, which is data storage as well as AI. You got 150, if my memory is correct, from Alphabet, and 120, I think, billion from Meta. So you put those 3 companies together, they've almost got no choice. Otherwise they're going to get replaced. So they're spending lots of money. Okay, are they going to be profitable? I mean, I can imagine if you're investing in energy, energy is going to get used, stock's going to go up. You can see in Europe they haven't spent money on defense. They've got to. Okay, AI. I mean, is it not some of them a bit? I can imagine Meta. Let's go with that one. 3.7 billion users. Okay, they're spending 120 billion. Are they going to make a profit? Maybe, yeah. Okay, some of the other stuff, well, ChatGPT is one, OpenAI. I mean, I can't see how they can make a profit. So does that not impact the equity market to some level?
Well, yeah, it does, absolutely. But I think what we've seen with the market this year is those industries where the AI is seeking to disrupt, like software, like services of some sorts.
Yeah.
We're seeing the market really derate those types of companies. And also we're seeing the market kind of pull back on some of those big hyperscalers like Meta and Google, because these capex numbers are increasing so much, and it's changing the nature of those companies. The attractive nature of these hyperscalers historically has been they've been asset light, generate very high levels of profitability, and every sort of additional user that they sell a service to, that just flows down to the bottom line. Now they're changing into almost more of a sort of big industrial, where they're building massive plants. And with that, that's changing the nature of their profitability. All these hyperscalers now are spending approximately 100% of their cash flow. They're reinvesting it immediately into additional capacity.
It's interesting that when you think about AI, and you talked about these software companies selling off, I'm 100% with Nigel on the capex spend. It almost seems a Ponzi scheme. One person's lending to another, to another, to another in this circular economy. I know Mr. Roberts has got a quick question, and so I'm sure I'll come to him next. But it does seem interesting, and it seems to reflect in your portfolio, Matt, is that actually there are a whole load of industries that can't be disrupted by AI, and actually could be the beneficiaries of this capex spend. Materials companies, there are a load of stuff. I mean, I was walking with my daughter the other day, and she was worrying about AI and what it does. I kind of said, well, the sandwich you just ate in the pub can't be AI'd. The beer you had, your dog can't be. The building, your house can't be. There are plenty of things out there that were once unloved industries that are much more physical in nature that actually cannot be disrupted by AI, and many of them may be beneficiaries of capex spend. And so I guess that plays to a lot of your portfolio now.
Yeah, absolutely. I mean, we have a big overweight to a very unloved area recently, which is consumer staples. To your exact point, AI is not really going to disrupt the manufacturing of food products, for example, right? If anything, it will be a beneficiary, it will be an efficiency gain, but it's not going to disrupt an industry in the way that it could disrupt more sort of asset-light areas like software, for example. So yeah, absolutely. And I think we are seeing a sort of swing and a realization in equity markets that those sorts of companies have actually got pretty attractive characteristics. And onto the point of inflation that we discussed earlier, again, these companies are well placed to deal with inflation because they have such strong pricing power. Okay, yeah, there's been maybe some concerns over the cost of living issue that there may be a limit to how much they can increase prices, but there are other drivers and exciting opportunities there as well.
I think your point on inflation and your portfolio being able to deal with it is there's a lot of evidence because in 2022, when markets got absolutely hammered, I think in sterling terms, your portfolio was actually up in a world where markets fell 20 to 25%. So, and obviously 2022 was driven by the fact that people worried about inflation. Mr. Roberts, handing over to you, you've got to be very patiently sitting there with your hand, and then I'm going to go to some of the questions that have been firing in, and I'll point those to the relevant people.
Yeah, it's just a quick one on AI. We've been seeing a lot of pre-IPO deals. A lot of the big AI companies are still private, and we've seen a lot of pre-IPO deals come across the desk recently. Just to give you a flavor of one of them, so we recently had a deal valued at over $300 billion, revenues of $8 billion, which, by the way, is coming largely from other tech businesses, right? So not necessarily actual consumer demand. There is that cyclicality to this thing. And current profits running at minus 13 billion, right? So currently losing minus 13 billion. The Excel spreadsheet's predicting they go positive in 2029, right? So you've got 50 odd times revenue on a business that's generating minus $13 billion of profits, right?
Sounds cheap. Sounds cheap.
Right. So, and there's dozens of these types of things going around at the moment. So don't get me wrong, there might be one or two of them that make it and are amazing as the next NVIDIA or whatever it happens to be. But the point being is there's going to be a number of failures in there, and that has to be recognized. So the word realism that Matt Page was talking about there is absolutely key.
And referring back to Nigel's point around 60-40 doesn't work. I mean, we've emphasized on why the 40 might not work, but actually the 60 really is just about eight US tech stocks now because of the way the indices have been moved in the direction, and they effectively, the Mag 7 tail wags the S&P 500 dog. And I think that that might have changed as well. So not just the 40, but also the 60 could be in trouble. I'm going to answer a couple of questions. I might go to you, Nigel, first. How gold calls can disrupt the current upward trajectory, and in your position, structured products, how such risks can be addressed. I think the question really is, can we use structured products in a sensible way to get access to asset classes like gold?
So there's a recent structure note that I did that's 150% of gold or silver. So literally what happened, the market fell, and then I bought an option, if you like, at that particular time. So it's underpinned by a bank, and you've got 150% of the upside, worst of gold or silver. So by having a structured note, if gold makes 30%, you actually get 45. So you can structure it. You've got to buy at the right time, and obviously deVere is able to do that. If the markets from memory go down by 20%, you get 100% of your money back. So if you buy gold, they go down, okay, you get 80% back. But if you buy the note, okay, I think the barrier is at 30%. It's got protection in there. So we structure these types of things. It needs a big company to be able to do it, because obviously I've got to purchase on the day, and there's an investment 5 million that typically you're using to take the product.
So you put the pricing power of deVere and also just your access to the banks. I know the banks don't like to be doing a lot of structured products, particularly at the retail end of the market, unless they're dealing with the best or the most regulated.
Well, they need to know that the money's coming in.
Yes, that is amazing. Another question saying there's been a lot of chat. Are there any charts or tables to underpin the points of that? I think the important thing around that is, of course, there are. I suspect if you ring up James Green, he or one of his team will be able to get you a meeting, and you can talk through all the charts that you want. There's another.
Just on that, Matt, there are a few questions on how do I speak to somebody. I love that question. A lot of chat, any charts. How do I speak to somebody? You are welcome to message me on LinkedIn. If you do not have a deVere advisor, feel free to send me a message. Let me know what you're looking for and where you are based, and I will point you in the direction of somebody that's licensed and regulated in your area. So James Green on Instagram is fine, on LinkedIn is fine, or you can go to our website, devere-group.com, devere-group.com, and in the top right-hand corner, there's a blue box that says Become a Client. You click that, and the website will point you in the right direction.
I mean, the stats that I've got available, I'll make available to everybody, or to all the advisors and anybody that's attending as well.
Brilliant. And so another question, will the recording be shared? Of course it will. Let's go on to, well, I mean, there's a load of questions here, but I wanted to talk a little bit about crypto, partly because Mr. Joy was very punchy on that. We know it has use cases because particularly in emerging markets, it has significant use cases. But maybe both Nigel and Mr. Roberts, any view on the sort of decoupling of Bitcoin as a safe haven asset from gold? And it's one of the questions, one of the things that
I don't know if it's decoupled. I think it's always been not necessarily tracking. But I mean, I think if you go back, and it's a good point for gold, gold's been trusted for 5,500 years, right? So I mean, just think in times when you don't trust, what do you trust? Bitcoin over 10 years. Okay, the question with Bitcoin really is it's correlated with software stock. So it's actually quite correlated with tech stock in general, but software stock. So if you check the correlation, it's incredible. So kind of think, is it the future? What is the future? Okay, well, if you look at those types of stock, it's correlated with those. So when you think in Bitcoin, I think you have to think, do we get digital assets? I think that's always been the point. Do we get digital stock? Do you get digital currencies? Because the argument for Bitcoin really is that, do you want a government keeping score? Do you want the computer keeping score? Okay, that's one argument. Do we trust it like we trust gold? Well, obviously not. That's been proven right now. But are there digital assets? And if the world becomes digital, then it would be logical, if you have digital shares, digital currencies, that then it would be a reflection of a digital gold. So I think, that's a little way down the road, perhaps. But gold is an investment in the future, or Chris would say it's a bet, right? Because either it's just going to go down.
I think you're right, though. I think that what underpins the blockchain, which people don't talk about so much now, but I think effectively cryptography and the blockchain are really what underpins Bitcoin, and they will have use cases way beyond Bitcoin. And as the world get used to that use cases, then potentially Bitcoin could end being the digital gold. I think that's a very valid point. Mr. Roberts, do you have any views on that? I know you're Captain Conservative sometimes. Protect your money, then grow your money is your favorite word. So any views on that?
Nothing more to add to what Nigel just said on Bitcoin specifically, but I would say there's the sort of cryptography, cybersecurity type theme, which I think is really interesting. And so, what with the development of quantum computing as well, which is when you look at that alongside AI and how that's going to be those two things are going to weave into each other. the need for cyber secure services is going to go through the roof, I think. And so
do you not think that quantum computing is still many, many moons away?
No, it's not. It's the advancement in that sector is coming on leaps and bounds.
Yeah.
Like in Oxford, in the UK, and in San Francisco and a few other parts of the US, there's like serious movement in this area. These companies are close now. They are close.
Yeah.
So I expect over the next 3 to 5 years, you're going to see quantum really start to play into AI, and that gets interesting. And so I think your cybersecurity services, technology, different types of computer chips, things like that are going to start to become a big conversation, I would say. These are smaller companies developing, but you're going to start to see them feed through.
Okay, James, you want to go quick fire? Because there's a lot of questions there, and
I want to go quick fire. I've got a question. Anybody that's used Claude 4.6 so far, probably blown away with it. Do you think Anthropic will disrupt the current weighting of the Mag 7? Will we see a Mag 8 in the future?
I think AI is changing the world. Claude 4.6. I mean, you've seen it where you can use it and you can get financial information. You need to know enough about the financial market to be able to use it, in my opinion. But I think it's a fantastic enhancement, and I can see why an information company, Reuters, shares down. I can imagine Salesforce. You can have a, do you need to pay Salesforce, or could you just actually have a half decent CRM system, put all the stats into that, and it'll give you all the information you need. So some companies, I think, do you need them as much? Do you need Salesforce? Okay.
I mean,
for me, I'm like,
data.
I'm not going to be investing in one of those companies because they could be disrupted. That's my opinion on it.
I think taking unstructured data and being able to structure it and using LLMs to surface that data, like Claude or Gemini or anything else, does mean, is going to change the world, I think, for a lot of these software companies.
Claude's incredibly accurate.
Yeah. And I think some of these large language models, one thing that is difficult is that they are quite industrialized. So although some are moving faster than the other, you feel like technology normally has this sort of accelerating, J curve. And what's interesting is it seems with LLMs that it's going a little bit like that. In fact, the incremental benefits or the incremental increases of each next version is becoming less and less rather than more and more. And I think that could be interesting because
it's arguable sometimes, but anyway.
Yeah, I mean, if you end up with industrialized LLMs where everyone's doing the same things, the value might not be quite.
You go small language model there as well. Okay, that's got a value. Anyway, a longer webinar. James, keep going.
Next question: gold ETF or gold structured note? Gold structured note because you've got capital protection and 150% upside. Yep. Gold structured note or gold miners structured note?
Gold miners. Let's take Newmont. To take gold out of the ground, it's 1,600 gold. At 4,000, they're trading at 18 times earnings. Market's around 30. So just think, you're getting a lower PE ratio, and they haven't repriced it with gold at 5,000. So with forward trade about 12. Is gold going to go below 4,000? Okay, I don't think so. So gold miners, you've got more upside. I think some of those gold miners significantly undervalued. And if you put those into a note, it's 27% per annum, I think, from memory. More volatility, but what is gold? If you go gold's 5,000, it's more likely to do 10,000 than it is 2,000. Okay, so my opinion. Could be wrong. Don't put all your money in it. Percentage. Always diversify.
If we just go around very, very quickly, because we've only got 7 minutes left. So Nigel Green, gold and silver, 12 months. Yes and yes. Up. Matthew Page, gold and silver, 12 months.
I'll take the other side of the coin. Down.
Oh, both.
On both, yeah.
Down on both. Okay. Matthew Roberts.
I'll go in between. I'll go gold up, silver down. How about that?
Matthew Lamb, would you like to give us an opinion on that one?
I would have said exactly the same. I think that silver is benefiting, it's being pulled along by gold, but I'm not sure that it'll carry on going up in the same space.
Okay, super. Matt, do you want to pick one last? I mean, I'm really sorry.
Yeah, I
We've
mean, there's
got
a
nearly
quick question.
700 people on here. There's lots and lots and lots of
Yeah, hundreds of
questions.
questions. Considering the high price in US markets, there's a question about small cap. Matt Roberts touched on it earlier. Matt Page, obviously, you're an equities guy. So maybe we should talk about where there's value in equities. You know, half a minute each, where there's value in equities. Start with Mr. Roberts.
Yeah, UK, European, and smaller mid caps look incredibly good. So if your PE ratios in the US are 25, 30, Nigel just gave you that figure. You can find stuff in the single digits in Europe and UK. Companies generating solid, robust profits, not necessarily susceptible to the AI disruption that we've been talking about. So I'm thinking sort of industrial type real world companies in Europe and UK. Got to be picky, right? You've got to be picky because there's going to be some washout with all of this. But I'd say active managers, European, UK, small cap, mid cap.
Mr. Page?
Yeah, I think I'd agree with that, but I would also not underestimate the US. If you look at what drove European equities last year, it was the valuation multiple going up and the earnings essentially went sideways. If you look at what drove US equities last year, it was the earnings going up and the multiple went sideways. So don't underestimate the US as an engine of earnings growth next year.
I think that is, we're running out of time. I'm just plowing through. There are so many of these.
So many questions. We get back to everybody on the questions.
Yeah, someone has opened the quantum computing genie, and so there's 6 million questions on quantum computing, which I don't think we'll go into. That there's some more physical gold questions. We've heard some differentiation of views. What is clear is that Nigel's had some strong opinions, but one of the things he reiterates time and time again is it's about putting it in at the right size. It's about blending different ideas and different thought processes and creating diversification, not diversification, not so much diversification you can't get any returns, but the right and appropriate risk managed diversification in a world where there's huge uncertainty will allow you to be the escalator, not the roller coaster in your current portfolios. And as we always said with deVere, so much of the outcome is actually not the bright people that we've heard on the phone today. It is actually the planning and the advice. If you can save IHT, if you can give cross-border advice, those are things you can actually control versus markets. We often talk about the alpha being in the advice. The advice and where you want to be is the very first call. Our job as fund managers and portfolio builders is to sensibly and cost efficiently compound your assets over time. Get the advice first. Doesn't come from us. That comes from James and his team. I think I'll wrap up. I don't know whether, James, you've got any last comments.
I did have, yeah, but you've just used all of them. So those are my last 2 points. It's not just diversification, it's making sure you've got the right diversification, as we've heard today. To speak to an advisor, if you already have one, reach out to them. And as I said earlier, please feel free to contact me on LinkedIn. If you don't have an advisor, or Nigel on LinkedIn, he's very, very active on LinkedIn, or just go to the deVere-group website, just press become a client in the top right corner, and that will point you in the direction to make sure that you speak to someone that's regulated and licensed wherever you are in the world. A big thank you from me. Thank you to the fund managers. As I started with, I chose people who had some contrasting opinions in there. I thought it was a brilliant session, extremely informative. So a big thank you from me. Nigel, anything you want to say as a final point?
No, thank you again, everybody, and thank you for logging on. There were lots of questions there. I'm going to ask Matt Page if he could just do something for us on quantum computing, because there was lots of questions there. So either a video we can send to people or some text, whichever, please. Okay, because there was lots of questions. It is a fascinating subject. So if you've got something that we can do, I saw lots of questions there coming in on the dollar. And again, okay, I'll do a video and send that out to people that want my opinion on. And really, I'm just saying that the diversification here again, is the dollar going to collapse? Okay, well, probably not unless there's a major civil war or something breaks out. That's unlikely. Okay, however, social unrest, potentially. makes a fall. I'm arguing that it's sensible to have some diversification, hence why I'm saying some exposure to gold, for me, is sensible. Overall, I think all of us collectively do agree it is, as Matt Roberts calls it, smart diversification. So whether it's the Guinness Equity Fund is not just investing into equities, they're choosing the best, the most powerful companies, and fantastic record that Guinness have got over 12, 13 years of just consistent performance. And the same with Matt Page there, Matt Roberts is looking at it, and a hedge fund can go long and short, which of course then you're just really giving that extra security. And Chris has almost got the easy job, eh? Who's looking for the fixed, but that fixed is relevant to have, particularly people who don't want the volatility in a portfolio. And we've got lots of clients that would just like to stay with that. So again, as James said, lots of reasons to talk to an advisor. We are available, LinkedIn, Instagram, etc. We're going to email everybody, and we will respond to everybody with more information, because ultimately we want to be able to give you that information so you can make the right decisions to increase your own wealth in a tax efficient manner. Okay, that's obviously our goal for you and us as a company to continue to build and look after our clients. So thanks everybody. Hopefully you found it useful. And we'll look forward to the next one, James.
Absolutely.
Well done, team. Thank you very much.
Thanks, everyone. Bye-bye.
Take care. Bye.